The Federal Reserve cuts rates for certain reasons or raises rates for certain reasons. It's a given. This has been the history of the Federal Reserve. Federal Reserve, I look at as the gas, right? The gas pedal or the brake pedal of the economy. That's the way I look at the Federal Reserve. Federal Reserve can only influence the short-term rates on the short end of the curve. Long end, they cannot do much about because that market is so huge. Proof is in the pudding. They cut the short-term rates by 100 basis points. Long-term rates in the 10-year, 20-year, 30-year bond is up 100 basis points since they did that. However, Fed cutting the rates, the reasons, two reasons. Well, one, obviously, they're looking at economic activity. If the economy is slowing, as a preemptive suggestion, they start cutting rates. Now, the market did not read any of that into it. Okay, not yet anyway. But there is actually, did I put that up? No, I didn't. On Monday during trading with Sergio, I'll show you guys that graph. During interest rate cut cycles, actually, the market goes lower for the fact that the economy is slowing down. Now, I don't think the Powell caved under pressure. If you look at all the data, and you guys can all go check this if you're interested in macro, go to FRED, F-R-E-D, Federal Reserve Economic Data. There's a website. You can get infinite amount of macro data from credit card defaults to delinquencies to mortgage delinquencies to unemployment. You can get everything, okay? So when I look at the macro picture, Fed cutting rates in our history has happened a couple of times that most of you remember. I remember the dot-com bubble, but that was a different story. But economic macro picture changes before the Fed starts cutting rates. And so it happened in 2008. Okay. What happened is that market topped. We got a housing crisis, right? The financial crisis, and Fed aggressively started cutting rates. While they were cutting rates, the market was selling off heavily, right? Close to 40, 50%. But what it does, at some point, there's a lag between Fed cutting rates and those rate cuts, being reflected into the economy in general, the general economy. So Fed cutting rates while all asset classes are close to or at all-time highs doesn't make sense. So are they seeing a slowdown in the economy? Or is this just keep the music on? We can't stop the music. The musical chairs need to go on. And was that it? I don't know. But obviously everything reacted very positively for now anyway. Let's see if we go make all-time highs. We probably will. So we'll see. We'll see how we close today. And the second part of it is Fed raises rates, right? When did they raise rates? Well, when the pandemic happened, we had a massive interest rate cutting cycle because the economy was about to just die. Everybody's at home. GDP collapse during the pandemic. They cut the rates. They kept something called ZIRP, zero interest rate policy, for way longer than they should have, right? And who showed up? Inflation showed up with a vengeance. And whatever the government says, double that, by the way. That's what inflation is at, current inflation. So when they say it's 2.5%, it's 5%. And at the peak of inflation era, when we had it after the pandemic, because we printed and pumped in $7.5, $8 trillion into the economy, inflation showed up ultimately. And Fed was late to the party again. What did they do? They start raising rates this time, right? So now we've been in a raising cycle until last September, where the Fed started cutting rates. If you look at all the macro data, the economy is softening. Unemployment rates are going up. And the Fed mandate is what? 2% inflation, full employment. Well, unemployment's going against it. The inflation numbers are hotter than expected, but now they're cutting rates. So I have done, about a year ago, I started talking about something called stagflation. You guys will hear this on CNBC quite a bit. Usually I'm early on these things, I've done a couple of videos. You can go on the channel and check out, search stagflation, what it is. Stagflation comes together by two words getting put together. Stagnant economy, slowing down economy, and inflation, right? Inflation from inflation. That means you have a combination of slowing economy with higher inflation. But we're getting higher PPI, higher CPI numbers, right? So honestly, if somebody knows, let me know. There is no cure for stagflation. There is cure for everything else. There is cure for inflation, which is raising rates, which is what the Fed did. There is cure for deflation, although it's a horrible cycle, like Japan in 25 years, negative interest rates. So, but there is a cure. For stagflation, there is no cure. Let me explain why. Stagnant economy requires lower interest rates, right? Or slowing down, a slowing economy. But what happens when you lower interest rates? It fuels inflation. Get it? So we're in a box if we're in a stagflationary period. We can lower the rates because we think the economy is slowing down, unemployment's going up, all that stuff. And what is going to be, by the way, the effect of all this AI on unemployment? I think it's going to be huge. I think all these jobs getting replaced in the next 5 years, it's going to be huge. We have to deal with it. So, but that's in the future. So at the moment, if we have a stagflationary period, market's not reading into it yet, which is fine. But you guys will start hearing this tune on CNBC quite a bit because all those clowns, they're just always late. They talk about it when it happens. So in a stagflationary period, if you lower rates because the economy is slowing down, you're going to refuel the fire of inflation. So you guys see what's going to happen, right? So if we raise rates on a stagflationary period to slow inflation down, then you're going to kill the economy. Do you guys see that? There's no cure for it. You're just in a box between a hard place and a rock.